Hello Deep Valley community, thank you for joining me. In this video I'm going to talk about dividend cover. This video is for educational purposes only and it's aimed at the dividend investor. So if you're new to the channel, please subscribe now. This is our value investing journey. So let's crack on. The company that I'm following here today is Viacom. I do not have a position in Viacom. This video is for educational purposes only. Viacom will release its report this week. This film is recorded in May 2020 before the earnings come out. I believe that the dividend will get cut when they report next week. It may not, but I believe that it's imminent. And through this video, I want to show you how I came to this conclusion. You can see that in 2019, Viacom made 3.3 billion in earnings. And you can see here the dividend and here's the payout. Approximately 15% or so, depending on when you get the dividend relative, if you take it from the start of the year or as it goes through the year. But for all intents and purposes, it looks like the dividend is nicely covered by the earnings. Indeed, you can see here approximately 3.3 billion of earnings, making a 0.78 per share payout, which approximates about 5% yield at the time of recording. If you come to its cash flow statement, you can see very similarly 3.3 billion here of earnings. And if you look at the cash flow from operating, it's only 1.2 billion. Again, I'll repeat that. So if you come to the cash flow statement of the company, you can see that while its earnings are 3.3 billion, because of changes in working capital, it's actually cash flow coming in is 1.2 billion. Moving on. So this looks like there's a lot of information here, but I've literally just gone through everything and just squashed it to the top. So again, approximately 3.3 billion of earnings, 1.2 billion of actual cash coming in. If you go lower down the cash flow statement, you come to investing activities. And I'm going to go through this investing activities slide here. So here's a couple of things that we should bear in mind. The first one is that the company has some non-recurring proceeds from divestitures. You can see here that the company is trying to liquidate its assets to generate some cash. Okay? So that is not recurring. That's a cash infusion that's not going to repeat next year. What is recurring is the company capitalizing, doing capex and making investments. So this here for 2019 approximates about 520 million going out. Okay, so you got your you got your earnings here at 3.3 billion. Net cash flow from operations of 1.2 billion. And then we have this slide here where you look at the investing activities. So as I said before, the company has net income of 3.3, cash flow from operations of 1.2, the capex and investments that are going out on a recurring basis at approximately 500 million. So the company's free cash flow, actual cash flow to the owners of the company, are 700 million. The dividend payout in 2019 was approximately 600 million. So when the company's gone through its full year, the shareholder has had a dividend payout of 600 million. The company has 100 million spare from its free cash flow. So again, here's the free cash flow, 700 million. This is the dividend payout. If that was the end of the story, that could keep on going forever. The problem is, you come onto the balance sheet and you can see here, the company has 600 million in cash. This cash is breathing room for the company. Then you look at the long-term debt, and you can see that the company has approximately 17.3 billion of net debt if you take out the cash from the debt. Even not considering any pension liabilities, not considering any other outgoing commitments, just looking at the debt. Now, if a company has approximately 17 billion of debt and the actual free cash flow available to pay the debt holders is only 100 million a year, it's going to take a very, very long time to be able for that company to pay back the debt holders. Now, there are two problems in short. When the company comes to refinance this debt, the debt holder wants to know that they're going to be compensated for being able to lend more money to Viacom. So they're going to ask for a higher interest. So that's straight away going to burn further into the shareholders' free cash flow. The second problem is that this excess 100 million in free cash flow was made in 2019. 2019 was a very strong year for advertising. In the case of Viacom, its business is predominantly driven through advertising. Now, I've used this example of Viacom, but this type of analysis you can use pretty much for any company. You just have to think, does the company have enough excess free cash flow to pay down its debt and pay down the dividend? So in this slide, I'm just going to recap. So next time that you see a company that has a low payout ratio relative to its earnings, I believe that it's worthwhile doing those two things that I did. Go through and figure out what is the actual free cash flow that the business can have, and look at its balance sheet. If it has a lot of debt and the actual free cash flow to the shareholder is quite small, it might not have a lot of wiggle room, because the company, Viacom in this instance, but it could be any company, you have to think, okay, has it gone through a very good period? Has it gone through a period where the economy has been very strong? Does it have enough breathing room so if the economy contracts significantly? So I hope you found that video useful, and as always, please subscribe.